Hello, today we are solving May 2025 Unit 2 IAL question number 1, part C of the question. Part C of the question, it says that you have to calculate the net present value of the project for the value of the project at the end of year 5. Now the other informations are all given here for the Metropolis company, okay, traffic PLC company. So it is actually using two methods to finance a project. Okay, option A is through the bank loan, option B is through the funding package. So in the first part we had calculated weighted average cost of capital for option B, and we had said this was the best option as compared to option A. Now in this part C of the question, we are supposed to calculate the net present value of the project at the end of 5 years. The formula for NPV is the net present value of any investment you are going to do is the sum of, you will take a sum of the net cash flow that is happening within the company times the discount factor investment. So that's how you will calculate the net present value. If it is positive, it is a good investment. Otherwise, if it is a negative, you are not supposed to invest. Okay, it might result in a loss. So now let's calculate the net present value. So first one, we have to calculate what is the net cash flow that is going to happen. So what is the net cash flow? Okay, net cash flow is going to be equal to revenue minus your costs, okay, that's happening. So that we have to calculate that. First, the following information applies to the forecast revenue of the project. The city has a population of 800,000 people. 35% of the population of the city have a motor vehicle. 6% of the motor vehicle will have to pay the charge because they do not meet the environmental regulations, and motor vehicles not meeting the regulations are expected to make 2 journeys per week. There are 50 weeks in a year. The charge for the motor vehicle that does not meet the regulation will be around £5 per year. So is going to be equal to, so the total number, quantity times the cost. Okay, now let's calculate quantity times the cost is the general formula. Now what is a quantity? Okay, there are how many number of people are you going to take into account? So 800,000, okay, 800,000 will be the total number. 800,000 times 35% of this population we have to calculate, and out of that only 6%, okay, 6% of the population will be will not be following the traffic regulations, and they are expected to make 2 journeys a week. So out of all these people, 2 journeys, and they are going to do that for 50 weeks per year. Okay, and you are going to charge at the rate of £5 per journey. £5 per journey. So this is how you will calculate. Okay, 400,000. So that is equal to 400,000 pounds. Okay, you will get a revenue of this much amount involved. So costs are nothing but, okay, for that they have given the information here. The following information applies to the forecast costs of the project. Capital costs is there, and then other costs. Okay, so but we need only the other costs, or the not the investment, okay, or the investment cost. So let's calculate the cost which is involved here. So first one is the other cost, maintenance cost. So first is the maintenance. So maintenance cost, then office rental cost is a cost to pay this. This is yearly maintenance cost which is going to happen. Staff cost, you have to pay the staff wages. Then electricity costs, then you have license fee, and then you have other costs. Okay, so these are the costs we have to calculate. Okay, staff cost, electricity cost, license fee, and other costs. Okay, now let's calculate. The maintenance will be 750 pounds per camera per year. Okay, so now again the quantity times the cost, okay, involved. So we know the cost is this much, but what is the quantity of camera that was installed? Okay, let's calculate for that. So they are saying 200 cameras were installed. So 200 cameras, and for each camera there is 750 pounds maintenance cost involved. So into this much. So this is the maintenance cost that's happening. So 200 times 750 pounds. So that is going to be equal to so that is going to be equal to 150,000. So 150,000. Now next one is the office rental cost. It is 22,000 per month. Okay, for so office rental, it is only, he is saying 22,000 per month, but in a year there are 12 months. So let's calculate that cost. So 22,000 into 12 per month, okay, into 12 months. So this will be the cost. So 22,000 times 12 is 264,000. So 264,000. Then the staff cost, it is 110,000 per month. Wages have to be paid. So quantity times the cost. So per month into 12 months. So that is going to be equal to, that is equal to 1,320,000. Okay, 1,320,000. And then you have the electricity cost, it is 19,000 per month. So let's calculate that. So 19,000 pounds per month into 12 months. So 19,000 times 12 is 2,280,000. Then the license fee they have given, 50% of the revenue will be paid to the city council as a license fee. So 50% of, okay, 50% of 8,400, okay, 8,400,000. 84, that is equal to 4,200,000. Okay, nearly half of it you will have to pay as a license fee. So then you have the other cost, which is 750,000 per year. Okay, they have given the other cost, which is 750,000 per year. So we can write it directly. So 750,000. Now let's add the total cost. Okay, let's add the total cost. So 150,000 plus 264,000 plus 132,000 228,000 plus 4,200,000 plus 750,000. Okay, that is going to be equal to 6912,000. So let's write it here, 6,912,000. That's the total cost. Now we can write the initial investment as the 0 year. Okay, that is the initial investment, okay, which is considered, which has happened at the 0th year, and that we have to subtract. Okay, now first one is the revenue. The revenue for each year 400,000, have the same revenue model. The cost also is going to remain the same, 6,912,000. Now the net cash flow we have to calculate. Okay, that is also going to remain the same. So it is revenue minus cost. It is going to be 1,488,000. Okay, 1,488,000. Funding, the WACC value for option B was around 10%. So you will take the discount factor as per the WACC value. Okay, so now you will use this discount factor. So discount factor of 10%. So you will get a discounted cash flow. So 1,488,000 into 0.909. So 1352592. Now let's multiply this also, 1,488,000 plus 0.826. So that is going to be 1,229,088. Then you have the third one, 1,488,000 times 0.751, that is 1,117. So 1,117,488. Then you have 1,488,000 times 0.683, that is 1,016,304. Then you have the third, 1,488 into 0.621. So that is going to be equal to 924,048. Okay, the value of the money decreases over a period of time. So let's calculate what is the NPV left over for the initial investment you had made. 1,364 minus 4 million plus 1,3652. Okay, 1,352,592. So it is 1,352,592 plus 1,229,088, 1,117,488, 1,016,304 and plus 2,924,048. So that is going to be equal to 1,639,520. So this is the value. Okay, this is the value of investment at the end of 5 years. So this is the net present value So net present value, okay, net present value NPV at the end of 5 years, okay, at the end of 5 years. So this is the value of money that for your investments, so that will be left behind.